Hi, I'm Jonathan Wild, and we are going to cover how to compute straight line depreciation. Now, depreciation is the process of allocating the cost of an asset to expense while that asset is being used. However, depreciation does not measure the actual decline in the asset's market value or its physical deterioration. It's simply a way to allocate the cost of an asset to an expense. There are three factors that determine depreciation. The first one is cost, which simply refers to the cost of the asset and any other necessary and reasonable costs to get it ready to be used, like assembling and testing costs. The second factor is salvage value, which is the asset's estimated value at the end of its useful life. This is usually the amount the owner would expect to get for trading it in, selling it, or disposing it. The third factor is useful life, which is the length of time the company estimates the asset will be used in its operations. Now that we are all up to speed on depreciation, let's discuss straight line depreciation. Straight line depreciation means that depreciation expense is the same for each period of the asset's useful life and is computed as cost minus salvage value divided by useful life. Let's do an example. Assume a company purchased machinery on December 31st of this year. The machine costs $60,000 and the estimated salvage value is $6,000. The useful life is estimated to be 5 years. To compute straight line depreciation for each year, we take the $60,000 cost, subtract the $6,000 salvage value, and divide that amount by the 5-year useful life. This gets us $10,800 of depreciation for each of the 5 years of its useful life. This is why it is called the straight line method. Now that we have calculated depreciation, let's record the adjusting journal entry that will be made at the end of each of the next 5 years. When recording depreciation, we debit depreciation expense for $10,800 and credit accumulated depreciation for machinery for $10,800. The depreciation expense is reported on the income statement, and accumulated depreciation is a contra asset account to the machinery account, meaning it reduces the reported amount for machinery. This is reported on the balance sheet at the end of the first year as machinery of $60,000 less $10,800 of accumulated depreciation to get a book value for machinery of $49,200. An asset's book value is simply the asset's total cost minus accumulated depreciation. Alternatively, we could report machinery net of $10,800 accumulated depreciation as $49,200 on the balance sheet. Either way is fine.